If you are getting ready to retire, or maybe you just retired, let's take a look at a case study for $2 million in retirement. Maybe it's a little more than you have, or maybe it's a little bit less than you have. But what we're going to do is take a look at that, and I really want to just give you some nuggets of what we're looking at with a financial plan, some things to think about when you're looking at strategy to make sure that you're meeting all of your goals for retirement. So let's go ahead and take a look here. What we've got is Mr. and Mrs. Retired Roger. They've got $2 million invested assets. So you've got a property. Yes, their property's paid for, so we're not even worried about that right this second. We're not going to focus on that. We're solely focused on how much they have, how it's allocated, what they can live on, that sort of thing. So if we're taking a look here, Retired Roger, he's got $1 million. He is invested in a balanced portfolio. So 50% stocks, 50% bonds is how he's investing his money. It's all in an IRA account. Now, for Mrs. Retired Roger, a little bit different. She has all Roth IRA dollars. For the $1 million in Roth IRA, she's investing that a bit more aggressively with an 80% stocks, 20% bond allocation. So this is something that I'll talk to you about in a minute. We'll kind of really look through, but we talk with clients all the time about making sure that the Roth dollars oftentimes are best spent last in the plan because they're going to continue to grow tax-free. So allow those to be a bit more aggressive. Allow the growth on those dollars there when it comes to that. So let's go ahead and take a look at the rest of the plan. They're currently 59. They're about to retire. They retire at age 60, which is going to be January 1st of next year. So I've got the plan looking at 2025 forward for the breakdown here. As far as their income goes, yes, they're working right this second, about to retire. They don't have any savings that they're doing right now. It's basically like, hey, we're about to start this retirement thing. So with Retired Roger, he's got 67 years old. He's going to get $2,400 a month in Social Security. For Mrs. Retired Roger, we've got the same setup here, $2,400 a month at age 67 in Social Security. And so looking here, their goals. What are their goals? Well, they're going to spend $8,000 a month in retirement, but then they have $24,000 as a go-go. So oftentimes people are retiring. They're going to spend a little bit more in the early years in retirement. And so we've got it at retired's age of 60 when he retires. He's going to be spending $24,000 extra a year until through the age of 74. It's adjusted for general inflation, as with everything in this plan, to make sure that we're accounting for inflation, which we should have set here at 2.5%. Now, slow go years, they're going to eventually slow down a little, but they still want to go some. They're going to spend $12,000 annually from age 75 through age 84. And then the final few years, because we always want to make sure we have a life expectancy, planning horizon in here is age 90. So they're planning until 90 for both of them eventually passing away. So this is the breakdown of the plan itself. Now, when we're talking about the investment allocation, what I had mentioned with the investments a minute ago was that, we had 50-50 for Roger, 80-20 for Mrs. Retired Roger. So what we're looking at here is 65% stocks, 35% bonds is their current allocation. Now, one thing that I really want to talk about, though, is just what I had mentioned on making sure that the Roth is going to grow a bit more, because the opportunity there is going to best be fit where they're going to have the Roth dollars they're touching last. Take a look at their tax plan here. This is the tax strategy estimate. So if we're looking here, their federal income tax rate is going to be 25%, where they're steadily pulling from the pre-tax dollars, the IRA dollars. Eventually, they spend those down, and then they're going to have Social Security coming in, and then the Roth IRA dollars. So their income bracket is going to be super low, or their tax income bracket here. So if we're breaking all of this down, this really shows the projections. We can see that, yes, they're going to have some tax liability in their early years. But then in their later years, if we really go out to, let's say, 2053, 2052, guess what? They're possibly not going to have any tax liability at all. If we're looking at distributions, with the current plan, we have tax-deferred dollars. They don't have any taxable dollars or a brokerage account. So we're going to look at tax-deferred dollars and then pulling from tax-free. That's going to allow them to get over here to just past age 70 and not have much of any tax liability, so they don't have to worry about RMDs or anything like that. Also, they're going to be passing away, and they're going to have potentially, now this is getting ahead of myself a little bit, the Monte Carlo is going to read quite a bit different, but not adjusted for inflation here, $5,200,000 or almost $300,000, all tax-free going to their heirs. Now, we're going to want to look at the Medicare. And so what we talked about was there's going to be the tax-free dollars later on, but are they going to have any years where they're going to have to pay more in Medicare tax? It's called the IRMA tax that comes into play. So let's look here. Their modified adjusted gross income, if we're looking at the projected Medicare premium thresholds starting at age 65 when Medicare starts, it looks as though they're going to steadily stay below the limit. And then eventually their modified adjusted gross income is going to be next to nothing, which is going to allow them the opportunity to avoid the IRMAA penalty altogether. Now, so let's go ahead and take a look here at the different strategies. So I'm kind of cheating here and going to go ahead and give you this one because I had this one popped up. So what we've got is retired Roger, current plan 90% probability of success. I've adjusted this for today's dollars. This means that basically we've already adjusted for inflation and the kids would inherit $1.895 million if they were invested based on their current strategy. Now, what happens if retired Roger passes away early, let's say at age 75, and you know what? They don't want to be as risky with their dollars. They want to be super conservative. Well, this could put Mrs. Retired Roger in a really tight spot. 69% probability of success and $372,000 remaining at the end of the plan. As a planner, that's cutting it a bit close for me because there's not a lot. We can make some adjustments as time goes on when it comes to the ups and downs of the market. But if she needs $8,000 a month, there may be a time in this plan where it's like, hey, this is going to be cutting it really tight. So I don't like to see that low of a number and that low of a number at the end of the plan, especially when we know as long as they take a little bit more risk, they're going to have some opportunity here. Now, not only that, but if we're looking at the proposed plan in general, and we just look at the same strategy for both of them and saying, hey, they're both going to live till age 90, they still have an 88% probability of success, which is awesome. But what they're looking at here is only $737,000 remaining at the end of the plan. What I look at with a lot of clients and an error that they oftentimes make is once they get to a certain point in life, they want to be super conservative, even though a lot of the dollars they're never going to spend at all. They're wanting to just make sure that their accounts aren't going up and down because they can't handle the volatility. But the conversation we have to have with them is, what are your goals with these dollars? Oftentimes we hear, well, you know what? I'd really like to bless my kids and help them as much as I can. If that's you, let me know in the comments. But I know there's some of you that are watching like, kids? I'm not worried about my kids, or maybe I don't even have kids. I want the last check to bounce. And I've heard that many times too, and that's okay. But in this scenario, we're looking at, what if they're wanting to bless their children? Well, in the end, they're actually hurting them if they go too conservative with those dollars, because this could potentially leave them over $1 million more dollars to the kids for the beneficiaries. So just look at this, really think through it. These are just a couple ways to think through things. This may or may not apply to you on this scenario, but let me know what your thoughts are in the comments. And also, if you want me to run a scenario for you, let me know what you're thinking and what you want, and I possibly might run that for you.